Welcome to Reliable Accountants. Have you ever noticed a dividend payment appear in your bank account and wondered what it means? But then thought, wait, what's a franked dividend and what's an unfranked one? And how do these actually show up in your Australian tax return? Don't stress, I'll make it super clear in just a couple of minutes. Today I'm breaking down what franked and unfranked dividends are, how you report them in your tax return, and how franking credits can mean more money back in your pocket, depending on your marginal tax rate. Let's dive in. First up, what is a dividend? A dividend is simply a payment from a company to you, the shareholder, out of its profits. And in Australia, there are two main types: franked and unfranked dividends. So what's a franked dividend? A franked dividend comes with something called a franking credit. This means the company's already paid tax, usually 30%, on that profit before it paid you. When you get a franked dividend, you also get this franking credit, which acts like a tax credit for you. When tax time rolls around, you add both the cash dividend and the franking credit to your assessable income. But here's the good bit. The franking credit can reduce the tax you owe or even get you a refund. Let me show you with a quick example. Say you get a $700 franked dividend with a $300 franking credit. You report $1,000 of income, $700 plus $300, and that $300 credit offsets your personal tax bill. Now, what about an unfranked dividend? This is a dividend from profits where the company hasn't paid any tax yet. So you just declare the cash amount, let's say $500, as income. There's no franking credit and no tax offset. You pay tax on the whole amount at your own marginal tax rate. But how do you actually report these in your tax return? When you fill out your Australian tax return, head to the dividends section. For franked dividends, you report both the cash and the franking credit. For unfranked dividends, you just report the cash. The ATO adds up the amounts for franked dividends and automatically applies your franking credit as a tax offset. This can lower your tax bill, or even give you a refund if your tax rate is lower than 30%. Let's put this into real-life scenarios. Here's how it plays out depending on your income. If you're a low-income earner, earning less than $18,200, you get a $700 franked dividend with a $300 franking credit. Your assessable income is $1,000, but you owe no tax because you're under the tax-free threshold. So, you actually get the full $300 franking credit back as a cash refund. If you're on a middle income, say $60,000, same $700 dividend, same $300 franking credit. Your tax rate is 32.5%. Tax on $1,000 is $325 minus your $300 franking credit, so you only pay $25 extra tax. If you're a high-income earner, over $180,000. Again, $700 dividend, $300 credit. Your tax rate is 45%. Tax on $1,000 is $450, minus the $300 credit. You'll pay $150 extra. So, the franking credit always helps. But how much it helps depends on your marginal tax rate. Couple of quick rules from the ATO to remember. You must hold your shares at least 45 days to claim the franking credits. That's called the holding period rule. Always include both the dividend and the franking credit in your tax return. And if you don't give your tax file number to the company's share registry, tax could be withheld at a whopping 47%. For more detailed info, head to ato.gov.au and search dividends and franking credits. So, in summary, franked dividends =, companies paid tax, you get a credit. Unfranked dividends =, no credit, you get taxed on the full amount. Franking credits can cut your tax bill or boost your refund, and how much you benefit depends on your marginal tax rate. If you want help understanding your dividends or lodging your tax return, reach out to Reliable Accountants at 1300049534. And remember, knowing how your income is taxed puts you in control. Thanks for watching.